Let's look at this question. A company purchased an asset on 1st January 2003 at a cost of rupees 1 million. So 2003, the cost is 1 million. It is depreciated over 50 years by the straight line method. Nil residual value. There is no residual value. With a proportionate charge for depreciation in the year of acquisition and the year of disposal. So you need to take the proportionate depreciation. On 31st December 2004, the asset was revalued for 1.2 million. There was no change in the expected useful life of the asset. The asset was sold on 30th June 2005 for 1.195. What profit or loss on disposal of the asset will be reported in the statement? So profit or loss of the company for the year ended 31st December 2005. So you are given 4 answers. We need to identify the correct one. Okay, first of all, we'll take the asset was purchased on 1st January 2003. For how much? For 1 million. Okay, so I will take in thousands, so 1 million, and it is depreciated over 50 years. So therefore, the depreciation should be 1 million divided by 50 years. So there is no residual value. So therefore, straight away we can calculate the depreciation, which is going to be 20 per annum. Then this asset was revalued on 31st December 2004. So revaluation of the asset on 31st December 2004 for how much? 1.2 million. Okay, so this is a new value. So when the asset is revalued on this particular date, so we need to identify the net book value. Net book value. Then the difference between the revalued amount and the net book value will be revaluation reserve. Okay, so revalued amount is 1.2 million. What is the net book value? Okay, so for net book value, we know it was purchased on 1st January and it was revalued on 31st December 2004. So therefore, how many years? 2 years. The 2 years depreciation. Okay, so which is 20,000 per annum. So therefore, when you take 20,000, which is the purchase cost was 1 million. So 1 million minus 40 will be 960. So 1.2 million minus 1.2 million minus 960, how much? 240 will be the revaluation reserve. Okay, but however, this asset was sold on 30th June. Okay, so 30th June 2004. Okay, so new asset value, sorry, it was sold on 2005. So this should be 2005. So which means the asset was revalued on 31st December 2004. So 31st December 2004 to 30th June 2005. How many years? So only 6 months. Only 6 months. Okay. So therefore, the new depreciation should be calculated based on the revalued amount. So new depreciation should be on the revalued amount of 1.2 million. So 1.2 million divided by how many years? Now The original useful life was 50 years. Now after 2 years, there is no change in the what do you call the useful life. There was no change in the expected useful life. So therefore, this 1.2 million should be divided by 48 years, the remaining useful life. So which is how much? 1.2 million divided by 48, which is going to be 25,000 per annum. Okay, 25,000 per annum. But we need only for 6 months. 31st December to 30th June it was sold. So therefore 25,000 divided by 2 will be 12.5 thousand, 12,500. So how do you calculate the disposal profit? So disposal profit will be how much? Your sales proceed will be 1,195,000. So therefore 1,195,000 minus the net book value. Okay, so how do you calculate the net book value? The new value is 1.2 million minus the depreciation 12.5. Okay, so that will be 1,195,000 minus 1.2 million minus 12.5, which is going to be 1,187.5, which is equal to how much? 7,500. So here 7.5 means which is equal to 7,500. So therefore the correct answer is the first one, A, 7,500.